Wall Street just wiped 10% off of Meta's stock price because they're panicking about AI spending. But I think this could be a massive buying opportunity. Today, I'm breaking down the actual numbers to show you why the market has this completely wrong. And I'll show you the exact price I'm willing to pay for Meta stock. There are three main reasons why investors are selling Meta stock right now. The first reason is that Meta's capex guidance came in above analyst estimates. Capex, or capital expenditures, is the money a company spends on investments to maintain or grow the business. Meta, alongside the other big tech companies, have been spending huge amounts of money on AI-related infrastructure. As you can see from this chart, the combined capex spend of the hyperscalers over the past 12 months has already reached over $500 billion. Investors are unsure about how profitable those AI investments will actually be. Before Meta released earnings last week, Wall Street expected their total capex spend for 2026 to be between $125 billion and $140 billion. However, Meta actually raised the low point from $125 billion to $130 billion. Wall Street doesn't like this because it suggests that spending is still increasing, meaning that Meta's free cash flow will be suppressed for longer. Investors hate when the future becomes less clear, and the fact that Meta is still increasing their capex makes things much less predictable. There was also the fact that Meta's earnings per share came in below what Wall Street expected, but that mostly had to do with $2.4 billion in legal charges and $1.2 billion in severance related to the company's May 2026 headcount reduction. Headcount reduction is just corporate speak for layoffs. But the important point here is that the EPS miss wasn't actually caused by underperformance in Meta's core business. And then Meta gave revenue guidance for next quarter, which was lower than what Wall Street expected. Meta said it expects revenue this quarter of between $61 billion and $64 billion, or $62.5 billion at the middle of the range. Analysts were expecting guidance of $63.15 billion. But if we take a closer look at what's happening inside the business, I believe that despite what Wall Street is saying, Meta's moat is actually getting stronger. What it ultimately comes down to is whether you believe that Meta's AI investments are strengthening the long-term prospects of the business or weakening them. Personally, I strongly believe that Meta and the other hyperscalers would not be rushing into these huge AI investments unless they were 99% sure that they would be able to generate a high rate of return from them. And there's actually a lot of clear and easily accessible evidence to prove that Meta is already benefiting massively from their AI spending. In their latest earnings report, the company said that their advertising revenue grew 27%. Advertising is Meta's core business. It's how they make almost all of their revenue. The growth in ad revenue came directly from a 14% increase in impressions. An ad impression occurs when one of Meta's 3.6 billion daily users sees an ad in their feed. And the average price of an ad on Meta's apps also increased by 12%, which they say was helped by better ad performance. And this is where Meta's AI investments come in. That better ad performance is driven by improvements in how Meta serves ads to their users. The algorithm on platforms like Facebook and Instagram are now using large language models to show users more engaging content, which keeps them on the platform for longer. The longer a user stays on the platform, the more opportunities Meta has to place ads in front of them. And these AI-powered large language models are using the vast dataset from Meta's users to target ads more effectively. The combination of higher engagement and more targeted ads means that the millions of businesses who advertise through Meta generate a higher return on advertising spend, or ROAS. What do advertisers do when they make more money? They buy more ads. This is the entire reason why Meta's business model is so profitable. And then the other part of Meta's business, which a lot of their spending is focused on, is developing AI agents. You might have heard this term agent and thought it's some kind of marketing tool, but it's actually really important. Agents are basically just digital employees. They're developed to complete specific, repeatable tasks like a human employee would. But the difference between an AI agent and a human employee is that the employee has to eat, sleep, and take days off. An AI agent doesn't have those limitations. And in theory, there's no limit to the number of AI agents you could deploy, whereas the number of people in the workforce is finite. This is what the whole AI gold rush is all about, creating something close to, equal, or greater than human intelligence that isn't affected by the limitations that come with the human body. This market should be massive, and with billions of daily users and millions of business customers, Meta has the ability to distribute AI agents better than almost any other company. Now let's take a look at Meta's fundamentals to see how the numbers line up with the story. Meta's revenue grew 28% year over year. Interestingly, Meta's revenue growth is actually accelerating. You can see from this chart that Meta's quarterly revenue is consistently above 20 20%, which is very impressive for a company of Meta's size. But what about user growth? Meta's daily active people across all of their apps grew by almost 4% year over year to 3.6 billion. That number is crazy to me. How can you have over 3 billion people, almost half of the world's population, using your apps and still grow users by 4%? For context, that 4% growth equates to an extra 120 million people using Meta's apps every day. Then we have ARPU, or average revenue per user. This is probably the most important metric for Meta stock investors. It's basically just Meta's revenue divided by the number of users on their platform. It's up over 23% year over year. Notice that if you add the growth rates of ARPU and daily users together, you get roughly 28%, which is the same percentage as Meta's revenue growth. See how the numbers all relate to each other? And that's why I care more about ARPU than daily users. There's only so many people left in the world for Meta to add to their platform. So to generate revenue and profit growth, Meta has to get more out of their existing user base. So that 23% ARPU growth is a clear signal that Meta's core business is extremely healthy. Then I wanted to quickly mention free cash flow. This is by far my favorite metric. You might have noticed if you're a regular viewer of the channel. But free cash flow is actually declining. Why? Because Meta's spending all of it on their AI infrastructure build out. This chart shows Meta's operating cash flow, basically the money that the business brings in, and their capex, which is the money going out. You can clearly see that Meta's exploding capex is why their free cash flow is down so much, because free cash flow is just operating cash flow minus capex. To make it clearer, I've added free cash flow into the chart. Hopefully you can see the correlation between increasing capex and decreasing free cash flow, even while operating cash flow remains strong. So what about Meta's valuation? The stock currently trades at a 16 forward PE. This is a remarkably low valuation for a big tech giant like Meta. And on a price to sales basis, Meta trades at a lower valuation than both Alphabet and Microsoft. So with that being said, I'm going to show you my base case assumptions for Meta stock over the next 5 years and what price I'd be willing to pay for it. I think it's reasonable to assume that Meta can grow earnings per share at a rate of 20% over the next 5 years. And then I'll apply a 25 PE multiple. In this scenario, Meta stock would increase from $540 to over $1,600 per share in 5 years. That's a 25% annual stock price return, or 3x upside from today. To achieve a 15% annual return, which doubles your money in 5 years and quadruples it in 10, I'd look to buy Meta stock anywhere below $800 per share. With that big drop after earnings, I'm down by over $200 on Meta stock, but it still makes up over 10% of my portfolio. Thanks to some positive results from my other stocks, namely Microsoft, the portfolio is almost back in the green for 2026.